I don't know what just happened. Hi there, it's Mark Sebastian, the founder of OptionPit.com, and this is weekly options trading and daily option trading by me, Mark Sebastian. So let's start with the standard blah, 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 blah. It's your fault if you lose money, blah, blah, blah. Not our fault, blah, blah, blah. Education purposes only. Read away. We'll give that a minute. These are illustrative. All right. That's me. For those of you who have never met me before, my name is Mark Sebastian. I was a market maker for about 10 years, and then I started Option Pit. We are an education service. We work with retail and professional traders, helping them implement option strategies, where our goal is to teach the retail public to trade the way a professional would. Thank you. I appreciate that. And we also manage a couple of small hedge funds, and we're very proud of the work we do there. So, what are you going to do today? You're going to learn about a quick discussion on Decay. Talk about what the weeklies and the daily options are, why it's important to trade these contracts, some ways to take advantage of weekly and daily options on directional biases and income, and the use of weeklies in a high vol environment. We did a weekly trade this week where we traded a daily versus a weekly versus a weekly, really a daily versus a daily, and we in SPY on a 3 lot by 5 lot, I made like $250. Nice little trade. So let's talk about Decay. Right? Over the life of an option, the contract is decaying. Much like once you hit 21 or 22, you begin dying. Options, the day they are born, are on their way to death. Near-dated options, though, decay the fastest. So if they are at the money, that is key. The further out of the money you go, the flatter the decay. So if I'm looking at an option that is well out of the money, the decay is not exponential. So this is kind of the standard chart that I think a lot of people have seen. It kind of shows how decay is drastically increasing as time passes. And you can see it get bigger and bigger, but most drastically at 30 days, and then even more drastic at about 8 days to expiration. Thus, you can see how much decay you take off in a week. Look at this. Here's 30 days. Here's 8 days. Look how much decay is coming out. Pretty crazy, right? You take away almost as much decay in a week as you do in day 30 to day 22, or to day 8. But this is kind of, I think, the more important chart. And what I want you to notice is the way at the money and out of the money work. What do you notice about those out of the money options? It's a much slower progression, especially, look at this. This is from day 20 to day 0. It's almost linear. Meanwhile, so look at that. It kind of tells you what you need to know about at the money versus out of the money. You should already be seeing wheels turning in your head about what you think you should be doing. So the key to the equation with understanding option decay is that unless an option is at the money or right near the at the money, The old exponential decay most retailers are taught is not right. It's not right. How many people here have been told that options lose all their value in the final week? Right, well, it's partially true. At the money options do lose all their value in that final week. What doesn't is every other option. And even crazier are options worth less than a nickel. You know how fast options worth less than a nickel decay? They decay so slow. Options worth less than a nickel can take the entire week to go to zero. They can take an entire week. Why? Why would they take an entire week? Well, there's two reasons. One, there's not a lot of profit to be made in selling them, so people don't want to sell them. And two, it has to do with market makers. Market makers get punished for being short really cheap options. The cost of holding a cheap option can actually be greater than what you bring in when you sell it, because of the margin, the risk margin. You know, Goldman Sachs and Merrill and these things, they run a big program that tells you what your risk is. And when you're short cheap options, the haircut that we call it haircut, the haircut charge can be enormous. So most traders don't want to sell them. They get charged too much, and they have a lot of risk. They have a lot of risk. So they will take forever to decay. So an out of the money option kind of looks like this, really, in its decay. Looks like that. They won't lose that last 2 or 3 cents until probably the day of expiration. So any questions on decay? So let's talk about weekly options. They've now been listed almost a decade, believe it or not. They expired every Friday. What's interesting is initially they only listed one weekly on the Thursday before the next Friday. So there were 2 weeklies running usually. This produced absolutely nightmarish, crazy trading in weekly options for the first 6 months to a year. What would happen was they would list and everyone would try and price out the weekend right away. So realizing that it caused some crazy decay structures, SIBO began listing options 4 to 6 cycles out. Decay normalized to act like standard months. So weekly options trade a lot like regular options now. They're just the same, except they have different durations. So let's take a look at a weekly option. Here's Apple. And what I want you to notice is, look, it has 6 weeklies that you can trade. The ACK that expire tomorrow, the NOV 2s, the NOV 9s, the NOV 23s, the 30s, and the 7s. That's 6 cycles of weeklies, plus you got your monthlies right here, here, and here. Apparently they're a technology company that's in computer manufacturing. I don't know if I would say that. I guess your phone is a computer now, right? I guess so. So these are the weekly options. All right. So now let's talk about daily options. Daily options are listed primarily in SPX and also SPY. The S&P 500 options now can have up to 5 expirations in a week. Think about that. You can have 5 in a week. If the end of the quarter ends on a Thursday, you'll have in SPX an option on Monday, an option on Wednesday, an option on Thursday, an option on Friday morning, and Friday afternoon. If a Thursday, it's pretty amazing. We're going to get to 5 a week, to 5 every week. Eventually, there'll be an option expiring every day. Think about that. Every day an option will expire. Every time a bell rings, an angel gets its wings. This time it'll be, every time the bell rings, an option is expiring. I think I like mine better. What do you think? Not the opening bell, the closing bell. So, that doesn't mean there's an edge in weeklies or dailies, but there are some advantages. There are some things that you can do that I'm going to kind of show you briefly how to structure things. So here's a picture of the SPX dailies. Look at this is SPY. So I'm looking at 1, 2, 3, 4, 5, 6, 7, 8, 9 expirations. And this is before regular November expiration. The question is, do you think there'll be a time where options will continue to trade before and after hours, just like stocks? I do not. And if they do, they'll trade so wide that people won't want to trade them. The only people that would need that would be small retail traders, and unfortunately, they don't have much of a voice. You need an institution that needs that type of option trading, and they don't because they can trade the stock. So why weeklies and dailies? The answer is simple. There's 2 main reasons. Duration. Duration is huge. All right? The trader can decide how long to be in a trade from start to expiration. And more importantly, and this is key, it allows for the quick decay from at-the-money options. That's what worked so well in my trade that I opened up with. I did a butterfly that expired tomorrow on Wednesday versus a long iron butterfly that expired on November 5th. I sold the November 5th butterfly for the exact same price I paid, but I bought my regular butterfly back for less than $1 cheaper, over $1 cheaper. So that's one. That decay is huge. It's there. You just have to have timing and some application. But the other thing is timing itself. You can entirely avoid event risk. Want to trade Apple? You can be long up through tomorrow and avoid event risk. Or you can be long through next week and have all of the event risk. Traders can choose to take on or avoid event risk. That is so important. It makes such a difference in what you're doing. having the ability to time what you're doing is so key. Not Sochi, where they had the Olympics. So key, as in important. So let's talk about, now we're going to do some looking at actual trades. And I told you, I'm going to make this quick. Income producing, the key to selling weeklies and dailies is near at the money value. That at the money option has crazy decay. These are the options that should be sold. So think about this. You can sell an option that has exponential decay, and then you can hedge it by purchasing an option that has what? Linear decay, or if you're crazy, no decay. Right? You can buy those little cheapies. So let's look at an income producing trade using the Hawk, Trade Hawk. Ugly day for Amazon. Do not be surprised if it's up tomorrow morning, though. So let's look at SPY. And let's look at we'll call this a daily option. This expires tomorrow. You can see after hours it's off about $3. So gave away a chunk. But let's look at what you can do. I can sell. Let me go to a little wider. I'm going to go to all. Or 20 strikes. So tomorrow this option is going to be worth about $2.64. I don't think we're going to go a lot lower tomorrow. I actually think we're going to be bought. I think the open tomorrow is going to be the low. I could be wrong. 26 could be the ugliest day in stock market history. It could be Black Friday all over again. But let's say I sell this option at 162. If we just hang around, and then I can buy, that's the 267, I can buy like the 260s. This creates a spread. So what's going to be beautiful tomorrow is that if we hang around 267, if I sell this on the open and we hang around, let's just say I get these prices, just for giggles. If I sell this on the open and I collect $1.25, you know how long this is going to take to be worth less than $1? It'll take less than an hour. Because this at the money option is going to decay so fast. In an hour, this at the money option will be worth $1.25, and my 260 puts will be worth 25 cents. It's that simple. Now, more interesting for me in the weeklies is NOV 2. Look how expensive the 267 puts are. They're $3.80. $3.80. Really, tomorrow it's going to be about $5. And then I can go to like the 257s, buy these for like $1.35. Producing a nice delta. I'm buying a 21 delta put and I'm selling a 50 delta put. Question is, doesn't depend if SPYs goes in a new direction? No, what I'm looking for is for SPY not to drop or to sit or run higher. So what I want you to imagine is tomorrow we open 267. This my November 267 put is $5. My 257 is going to be about $1.84, $1.85. So I'll be collecting $3.15 on this. If we don't run around, which really, outside the last couple weeks, running around has not been something the market has done. If we don't run around, by the time of Monday's close, so I sell this tomorrow, on Monday's close, even if we're trading 269, this spread that I sell at, let's say, $3.15, I'll be buying back for about $2.75. Why? Because the decay out of this at-the-money option is so much faster than what I lose out of my out-of-the-money option. I'm trading exponential versus linear. That is the key to weeklies. If you leave with one thought here, folks, it's that I want to sell the exponential and buy the linear when I'm setting up income-producing spreads. Now, I can make it safer. The closer I get to the money, the more exponential that decay is. So I could set this up as a little put spread. No matter what I'm doing, if I stay within, so here's the key. Here's the key. Here's the key. If I stay within 35 delta to 65 delta, I will experience somewhat close to exponential decay. If I am less than a 20 delta, and certainly at a minimum 25, but better 20, my decay will become more and more linear. Right? So who remembers the old math question? A train leaves Chicago for Arizona, moving at 35 miles an hour at 1 o'clock. At 4 o'clock, a train leaves Chicago heading for Arizona, moving at 60 miles an hour. When will the two catch up? Does that sound familiar to anybody here? That's kind of what weekly options do. On a weekly option, it's two trains leaving the station at the same time, but one is moving faster and accelerating while the other one is moving slower and not speeding up. That makes sense? Good. Are the deep in the money trains moving slowly also? Yes. Is a time spread a good decaying trade in this environment? It can be. You've got to be careful, though. I'm going to talk about time spreads in a minute. And the best use of directional trading in weekly and daily options is calendars and butterflies. Depending on the vol, one can set up swaps. Sell one, buy the other. Find cheap vol and buy it, and expensive vol and sell it. Set up diagonals that take advantage of vol differentials. So let's take a look here. So now I want us to look at this SPY. And I want to show you something. And we're going to go a little deeper out. So take a look. Do you see the... Let me snip this. There we go. So I just want to take a picture of these trades. All right, see this IV number here? Right here? Get red going. Right here. Not the right one. And here. And here. See these IV numbers? What do you notice about them? What do you notice about them? What you notice is that October 29th is cheaper than the 31st, is cheaper than the 2nd, is less expensive, is more expensive than the 5th. Well, what day is November 5th? And I'm going to give you a big option pit secret right now. So everybody get your little option pit pens out. No, none of these are after the election. You would think it would be higher if it's day before election, right? Bob's got it. He said it's a Monday. They have been overkilling weekend decay. They make Mondays too cheap in the S&P and the SPY. November 2nd is expensive. Why is November 2nd so expensive? What's going on the 1st and the 2nd? Someone said Apple earnings. Yeah, it's Apple, Facebook, ExxonMobil, and Chevron all the day before November 2nd expiration. But take a look. I can do Monday to Monday, get a small credit. I can do Monday to Wednesday. Right? When are Facebook earnings? The 30th. So on the 31st, I have to deal with Facebook, but no Apple, no Chevron, no ExxonMobil. And I can sell almost the exact same premium as what I get out of November 2nd. And I can buy everything in front of it for dirt cheap. So why wouldn't I set up a trade using these dailies? So let's go to November 5th. Again, I've said for a while that I think, we're getting there. We're getting there. So I can buy the November 5th, let's say the let's go for that lower. I'm just going to set up a trade here. If I think we're going up, I could buy a 260 call for, let's say, $10. And then I can go where that decay is really high. And look at all the juice I'm going to get. You think that's a decent looking diagonal? I've got a 7-point diagonal that's going to cost me $6.85. If I think we're going up, it's a great, I mean great, diagonal spread. You think that's crazy? You should see what we can do when the VIX is 11 with these differentials. The stuff we can do when VIX is 11 with these spread differentials between different dates is astounding. So this is essentially a 1 week long position. With a ton of decay. That, if we do go truly off to the races, makes money. But if we sit in a range, kills it. Pretty neat, right? And, my aforementioned butterfly swap, I'll kind of show you what we had. And then we can talk about it. So on October 26th, I had the 271, 270, 263, 277, and I had it for $4. You can see it's worth $3. It's worth $3 now. I did this trade on Wednesday. Now against that, you're saying, well, Mark, that's a lot of risk if you do those. What if we make a wild move like we did today? Well, against it, I'll show you what I did. I had the November 5s because they're cheap. And I had almost the exact same trade. I had the 270, 271, and I was short the 260 and the 280. And I had that for $6, $6.08. Well, where's that pricing now? What does that look like? Let's see. Let's just call it five $535 and $295 for the straddle. So that total package is pricing $586. I got out of it for $6. Well, the best part was I had it on 3x5. So my 3 lot I made $300 on, right? Because I made $1 3 times. And my 5 lot, I lost 8 cents. That's $40. So I made $260. While, if the market went crazy, guess what happened? Are my strikes different on these longs? Long to short, are my strikes different? It's 281. Yeah, there were, instead of, I had an extra $3. So if we'd actually crashed, I would have made a killing. Plus I was long extra. These are the type of trades you can build with weeklies. So now, with the weeklies as high as they are, with the VIX as high as it is, weekly and diagonal options have been extremely high IVs. However, because they're short-dated, the relative cost of hedging is cheap. Heading into Amazon, Google, and Intel, earnings on October 26th, I could have hedged off all the risks. So take a look. This will be our last little trip to SPY lane. So let's say I'm worried about, like, we closed 270. I'm worried about the market tanking. Well, take a look. If I was really worried about Amazon, Google, and Apple, I could buy a 265 put for $1 and be hedged through tomorrow on my entire long position. Not a bad idea, right? So in summary, weekly options and dailies have tons of advantages. They make good income debit spreads and calendars. They can make amazing diagonals and swap trades. So now I want to talk to you about what we've got going on. On November 3rd, we're doing our next Saturday class. Our next Saturday class is on mastering weekly and daily options. So instead of 45 minutes of this, you're going to get 4 hours. It's by far the best class we offer. We have an old one that sells all the time. This is going to be updated better to the teeth. And at its regular price of $297, that's a deal. If you use code 100 off, 100 OFF, it'll actually take $125 off the price. So it'll be $173. Plus, I'll give you a 2-week trial of either the Vol newsletter or OP Live. OP Live is the chat room that I'm in every day for about an hour. And I go through trades, I look at stuff, I answer questions. Now, here's the key. Here's the smartest thing you could do that we don't advertise. You know how much our monthly subscribers to Option Pit Live pay for Saturday classes? 0. You know how much our monthly subscription is? $125. So you can pay $173 for the course and a 2-week trial, or you can pay $125 and get a full month of Option Pit Live and the course. Kind of a no-brainer, don't you think? So to sign up for this, you go to optionpit.com/events. Right there. Or you can go to optionpit.com and you can get the Option Pit Live Silver membership. Comes with some free education too, and it's just $125. You do the math. Do I trade iron condors? Yes. Not as often as I trade butterflies, but I'll show how they work in the week. We're definitely going to walk through them in the weekly class next week. Any other questions? Is the course about trading diagonals or butterflies? So it's a course about weeklies and dailies, but we're going to cover diagonals, butterflies, condors, and calendars and directional option trading using weeklies and dailies. And if you take the course and hate it, I'll give you your money back. Do Saturday classes come with silver or gold? They come with both. If you have an active subscription, then your $125 a month will go to it. But gold, their 4 months of gold is included. What is for you a high probability trade? Depends on the trade. I'd have to look at it. It's one where I have a positive expectancy. So we're going to teach you how to create trades that have positive expectancies. And the probability is doing many high expectancy trades together. So it's not just like, oh, it has 4% odds versus 8% odds. It's doing trades where I'm more likely to make money than lose, and doing those over and over again. Thank you, Jerome. I'm looking forward to it. Yep, 125 gets you the course and the monthly subscription. Correct. Kind of a no-brainer, right? Time spreads are great. The one thing I'd say about time spreads, especially in SPX, is use those Mondays as an anchor because they're almost always too cheap. Does every trade need a hedge? No, but a lot of them do. That's one of the things we preach is hedging. I think a lot of retail traders and a lot of less sophisticated institutions oversell Mondays. The question is, why do I think Monday is too cheap? So there's a certain amount of value in in weekend decay, but I think it gets oversold. Dave, thank you. And I think our subscribers will tell you how great it is to be a member of Option Pit. We take care of our customers. Do you slow down a bit for the Saturday classes? Because what is obvious to you is sometimes confusing me. Yes. So the way the Saturday classes work is a crescendo. Do I need your sophisticated option platform to trade? No. The way we work is a crescendo. So it starts very simple and gets more and more complex as the day progresses. You get to keep the class so you can see it. But with that Option Pit Live subscription, we give you a really good rudimentary options class that we're going to give you for free. With that Option Pit Live subscription that you don't get, the silver subscription, that you don't get with the Saturday class purchase. If you can't make it, is the class recorded? Yes, it is. All right, folks. It is now officially 8:30, and I'm turning into a pumpkin. I hope everybody has a great night.